Ever been gripped by the fear of missing out on the next big boom in the financial market? Ever been that everyone else is making a fortune while you're left behind? We've all felt it. The pressure, the anxiety, the FOMO. But what if this fear is leading you directly into a financial trap? What if you're about to make a decision that could cost you everything? Welcome back to the channel, loyal viewers and newcomers alike. Today, we're diving deep into a critical and timely topic. We're going to explore the wisdom of one of the financial world's most respected, Jeremy Grantham, and his stark warning to the market. The topic of this conversation: don't buy now. Stay tuned as we unravel complexities behind this simple yet powerful message. Jeremy Grantham, a seasoned investor, has seen it all. He's lived through the highs and lows of various market bubbles, gaining wisdom from each experience. He reminisces about the times when he too was lured by the glamour of quick riches and the fear of missing out. He saw his wealth soar dramatically, only to plummet shortly after. It's a roller coaster ride that many investors have taken, one that can be as exhilarating as it is devastating. Grantham's journey through these market bubbles has been enlightening, to say the least. He's seen the patterns, the red flags, the irrational exuberance that often precedes a major market meltdown. He's witnessed how a prolonged bull market, the longest in history, can lull investors into a false sense of security. He's seen the decline in speculative stocks, a trend that has historically signaled impending doom. Grantham's experiences have taught him to recognize the signs of a super bubble. He's seen how markets can tick all the boxes, displaying behaviors that echo those of previous downturns. And he's seen how these behaviors can lead to a market crash, a 50% decline in the broad market, particularly the S&P, with speculative stocks faring even worse. Recalling these experiences, Grantham can't help but draw parallels to our current market situation. He sees the same irrational behavior, the same overpricing, especially in the US stock market. He sees the same American-centric predicament that has characterized previous market bubbles, but Grantham's experiences have also taught him about resilience, about the importance of cautious investing. He's learned the value of focusing on high-quality stocks in good financial standing, particularly in times of potential crisis. He's learned that non-US stocks, particularly those in reasonably priced countries, can be a safer bet. And he's learned that emerging markets, despite their challenges, can offer a viable option due to their relative cheapness and growth potential. His experiences serve as a cautionary tale for all investors. They underline the importance of learning from history, of recognizing patterns, and of making informed decisions. Because in the end, it's not about making a quick buck. It's about investing wisely, strategically, and with a long-term perspective. What if I told you we're in the midst of a super bubble? Yes, a bubble that's not just inflated, but superinflated, ready to burst any moment. Let's explore the signs pointing toward this financial anomaly. The first alarm bell: the bull market. It's been running and running, in fact, the longest run we've ever seen in history. Now, long runs aren't inherently bad, but when it's this prolonged, it's like a marathon runner who refuses to stop, even though their legs are about to give out. They're bound to collapse eventually. What's more, we've noticed a degree of irrational exuberance, particularly during the COVID-19 period. It's as if people have been playing a high-stakes game of musical chairs, oblivious to the fact that the music has started to slow down. This kind of behavior is usually a harbinger of a market downturn. And then there's the decline in speculative stocks. We've seen this movie before, folks. It's like a rerun of previous market crashes. A significant percentage of Nasdaq stocks are already down by over 50%. They're like canaries in a coal mine, their decline a potent warning that the air in the market is growing toxic. So the million-dollar question, or perhaps trillion-dollar question in this case, is: could a market crash be imminent? Well, if we look back at history, at years like 1929, 1972 and 2000, they all tell tales of market crashes following similar signs. We may be looking at a potential 50% decline in the broad market, especially the S&P, with speculative stocks likely to take an even harder hit. But remember, the pace at which this downturn might occur remains uncertain. It's like trying to predict the exact moment a bubble will burst. Factors such as stimulus programs, individual investor behavior, and corporate performance will all play their parts. Could a market crash be imminent? It's a possibility we can't ignore. So let's buckle up, brace ourselves, and prepare for what could be a bumpy ride ahead. If you found this information valuable and want to help others be financially prepared, hit the subscribe button and join us in our mission to educate as many people as possible. By subscribing, you're not only supporting this channel's growth, but also helping to spread financial awareness. The US stock market is like a ticking time bomb. As we delve deeper into this financial landscape, it becomes evident that we're treading on thin ice. A close inspection of the US stock market reveals a worrying trend. Overpricing and irrational behavior are ramping up, reminiscent of past market bubbles. Let's take a trip down memory lane. Remember the dot-com bubble of the late 90s or the housing market bubble leading up to the Great Recession of 2008? Those were times when enthusiasm and irrational exuberance took precedence over sound investment strategies. Prices soared, not because of solid fundamentals, but because of speculative frenzy. And we all know how those stories ended. Fast forward to today, and it seems like we're on a similar course. The US stock market is witnessing a surge in prices that's seemingly disconnected from the underlying economic reality. Companies with little to no profits are being valued at billions of dollars, driven by investor optimism rather than financial strength. The echoes of past market bubbles are too loud to ignore. But why is this a problem? Well, just like a bubble, the US stock market's overpricing is unsustainable. When the market realizes that these sky-high valuations aren't justified, a correction ensues. And this correction can be brutal, wiping out years of gains in a matter of days or weeks. Now, it's not all doom and gloom. There are still pockets of value in the market. But the overall picture is one of extreme overpricing, which poses a significant risk to investors. It's like walking into a minefield blindfolded, not knowing when or where the next explosion will occur. So, what can we do? As investors, we must tread carefully and make informed decisions. It's not about avoiding the market entirely, but about being selective and focusing on companies with strong fundamentals. It's about being rational in an irrational market. The question isn't if, but when the bubble will burst. And when it does, let's make sure we're not caught in the explosion because, as we've seen time and again, the consequences can be devastating. In a world of financial uncertainty, how do you invest wisely? This question has perhaps never been more relevant than in our current climate, teetering on the edge of what seems to be a super bubble. It's a daunting landscape, but it doesn't have to be unnavigable. Your first port of call, quality. In tumultuous times, solid, high-quality stocks can be your bedrock. These are the companies that have proven themselves to be resilient, boasting strong balance sheets, steady cash flows, and a history of weathering financial storms. They might not offer the thrill of skyrocketing gains, but they provide a level of stability that's invaluable in a volatile market. But let's not forget the world beyond the US borders. It's easy to get caught up in the domestic market's drama, but there's a whole world of opportunities out there. Non-US markets, particularly those that are reasonably priced, can offer a safer haven. They might not grab headlines like their American counterparts, but they can provide a solid foundation for your portfolio. What about the emerging markets? They're not without their challenges, of course. They can be volatile, unpredictable, and sometimes downright frustrating. But they also offer potential. These markets, often overlooked in favor of their developed counterparts, can offer value for money and significant growth potential. They're not for the faint-hearted, but for those willing to take on a bit of risk. They can be a rewarding part of a diversified portfolio. And that brings us to the key word, diversification. When the financial landscape is uncertain, putting all your eggs in one basket can be a risky strategy. Spread your investments across different sectors, geographies, and asset classes. This way, if one area takes a hit, the impact on your overall portfolio is cushioned. In the end, navigating the investment landscape in times of uncertainty is about balance. It's about weighing risk against potential reward, about being bold, but not reckless. It's about understanding that the most successful investors are not those who chase the biggest gains, but those who protect themselves against the biggest losses. Diversification and caution could be your saving grace. Are we witnessing the end of the golden era? The past 2 decades have been characterized by a distinctive set of features that have shaped the global financial landscape. This period, often referred to as the Goldilocks era, was marked by an unusual confluence of factors that propelled corporate growth and profitability. We saw profit margins reaching unprecedented heights, largely due to the advent of technology that allowed for efficient business operations and cost-cutting measures. This, coupled with globalization, opened up vast markets that multinational corporations could tap into. The result was an era of heightened profit margins, the likes of which we hadn't seen before. Simultaneously, we witnessed a significant reduction in corporate taxes. Governments around the world, in their bid to stimulate economic activity, began to slash corporate tax rates. This move was intended to incentivize businesses to invest and expand, thereby creating jobs and fostering economic growth. The strategy worked, and corporations reaped the benefits, further boosting their profit margins. This era also saw an increase in corporate power. Businesses became influential players in the political arena, shaping policies and legislation to their advantage. This increase in power, coupled with the reduced tax burden and heightened profit margins, created an environment in which corporations thrived. However, we're beginning to see signs that this golden era may be coming to an end. Governments worldwide are starting to scrutinize these trends, questioning the sustainability and fairness of such a system. Initiatives to increase corporate taxes and regulate corporate power are gaining momentum. This is not to say that businesses will cease to be profitable or influential, but the extraordinary circumstances that characterized the past 2 decades are unlikely to persist. The business environment is evolving, and corporations will need to adapt to these changes. So, as we stand on the cusp of a new era, it's crucial to understand that the rules of the game may be changing. The strategies that worked in the past may not be as effective moving forward. The winds of change are blowing, and they're bringing a storm. Are tech stocks and Bitcoin all they're cracked up to be? A question many investors may be asking themselves, and rightly so. The tech sector, particularly the FAANG stocks, Facebook, Amazon, Apple, Netflix and Google, have been on a meteoric rise. But as we've seen historically, what goes up must come down. A closer look at these tech behemoths reveals some concerning details. Their current valuations are sky high, and there's a growing sense that these prices are driven more by speculative beliefs than actual intrinsic value. It's like a mirage in the desert. It may look like an oasis, but when you get closer, there's no water to be found. This isn't to say that these companies don't have real value. They do, but the question is whether their current prices reflect that value or whether they're inflated by market hype and speculation. Investors may be paying a premium for growth that may not materialize, and when reality sets in, the fall can be hard and fast. And then there's Bitcoin. Touted as a store of value, this cryptocurrency has been anything but stable. Its volatility is more akin to a roller coaster ride than a reliable store of value. One day it's up, the next it's down. And while some argue that it's a hedge against inflation, the reality is that its price movements are largely disconnected from traditional economic indicators. Bitcoin's value, much like the tech stocks we've discussed, seems to be driven more by speculative beliefs than anything else. It's a risky bet, and while it's paid off for some, it's left others in financial ruin. It's a bit like playing Russian roulette with your money. It's important to remember that investing isn't about chasing the latest trend or getting in on the ground floor of the next big thing. It's about making informed decisions based on solid research and a clear understanding of the risks involved. So when it comes to tech stocks and Bitcoin, tread carefully. How do you determine the true value of an asset? This question is the crux of investing, and it's becoming increasingly challenging in our current financial climate. Traditional metrics, like the price-to-book ratio, have been the bedrock of asset valuation for decades, but in our rapidly evolving economy, these measures are becoming less reliable. The book value of a company, for instance, can be a poor indicator of its true worth in an era where intangible assets, like intellectual property and brand recognition, often far outstrip physical assets. So, where does this leave us? If we can't rely on tried and true metrics, how do we navigate the turbulent waters of asset valuation? The answer may lie in looking to the future rather than the past or the present. Consider the dividend discount model, a method that values a stock by estimating future dividends and discounting them back to their present value. This method forces us to consider a company's future earnings potential, not just its current assets or earnings, and it takes into account company-specific factors like growth rate and risk, giving us a more nuanced picture of the company's value. But even this approach has its drawbacks. Future earnings are, by their nature, uncertain. We're making educated guesses, not concrete predictions, and these guesses are influenced by a host of factors, from broader economic trends to the actions of a company's management team. Some might argue that this uncertainty makes asset valuation more of an art than a science, and there's some truth to this. Valuing assets requires a delicate balance of hard data, educated prediction, and gut instinct. It's a skill that's honed over time, and even the most experienced investors get it wrong sometimes. So, as we stand on the precipice of potential market upheaval, rethinking our approach to asset valuation is more critical than ever. It's not about finding the right answer, because there often isn't one, but about making the best possible predictions based on the information we have. Valuation is an art, not a science, and right now it's more critical than ever.